Guys, we need to talk about this right now. The best market sector, being semis, is starting to disappoint in earnings, and this could lead us into the almighty correction. Yes, a movement down to potentially 4,700 becomes more likely as we move back into what we call a negative gamma situation. On top of all of this, though, crypto is also starting to fail. Often considered a risk-on or risk-off asset, it's falling below a very pivotal zone of 60,000. And as we know, there's no shelves on the left-hand side before 52K. So could this be the crash on the horizon? And more importantly, what does that mean for us as stock traders as we look at Tesla, AMD, and of course, even gold not staying safe in this current market turmoil? Stocks, commodities, and cryptos coming up. And don't worry, there's plenty of opportunities out there for all of us. Let's get into it. Well, welcome back, everybody, to The Daily Show. My name is Tom. Today, we're discussing the latest macro, the data, the lead indicators, and of course, the hottest charts that you need to be looking at. It was a bloodbath across the board, mostly at the close, which is the most important point we'll be looking at. But just remember, if you want to know why these types of things occur, remember to subscribe and smash that bell icon as we do cover these things daily, and we connect all of the points together rather than the narratives that you're fed through everywhere else. So let's discuss what's going on in the markets right now. Most importantly, the hot and the not so hot sectors. So you'll notice healthcare held up the best, consumer staples, and utilities. What are these? They're the three defensive market sectors. And that's usually what you would expect in a risk-off across the board type of session. Now, recently we've been discussing a lot of these risk-off style markets. And in particular, we've been focusing in on gold, utilities, energy, and metals and materials. Now, as it turns out, the month is over and they were the best overall sectors. And it's probably no surprise to many people out there. When you think about it, inflation's been on the rise, interest rates have been on the rise, and they tend to do very well for metals, gold, a couple of things like that. But the utilities component is something that I think will get even more interesting in the horizon. And I wrote over on X, following the links in the description down below, that I think XLU may perform the SPY over the next coming years, meaning that it actually might outperform completely the SPY because we are in late cycle investing. Now, that's not to say AI stocks won't do well. I think they'll do very well. And if we have a look here, utilities is now the best in terms of the direction dashboard. We picked it early, and it just shows you, if you haven't been looking at sectors, you've got to start putting together your technical analysis. And as Stanley Druckenmiller says, one of the greatest investors and traders of all time, you've got to be thinking about markets a little bit as a pig. Then you'll find the hottest areas, and you could therefore outperform the S&P 500. So while utilities is going pretty well and it had a pretty good month, what other things do we need to be looking at? Well, I went through and had a look at the performance surrounding this FOMC decision coming in less than 24 hours, and the market's acting very strange into the FOMC. Usually we get upward ticks into the FOMC, and the actual day itself is pretty bad. So FOMC decision days, around those periods, that's when we usually see the risk off after the FOMC, and we generally see risk on into it. Now, that's the last 5 years, so it's pretty relevant to the current environment that we've been in. This time, we're leading in with a bit of sell. So we need to start saying, well, is this market healthy or not? So when we try to answer the question of whether the markets are actually pretty healthy, you've got to look at some of the stocks. And of course, Amazon just gave its earnings, and I've got to say it looks pretty good. Revenue was $143.3 billion, up 13% year on year. Operating income was a record, up a huge amount. And of course, AWS revenue grew 17% year on year. Cloud revenue in particular across the board is really running rampant thanks to the advent of AI. So Amazon really doing well. Quite a lot of great reports there. And you can see on this particular chart, the revenue is significant. When you have beautiful revenue curves like this, then you can afford to have a higher forward PE. And I do think that this stock, along with Google and of course Microsoft and Nvidia, looks very good on the metrics and the charts. Now, as we reported in the previous video, where are the upgrades coming? So this has not been a terrible earnings season this so far. So that means that even with pullbacks coming through, in general, you have to expect Wall Street to be looking at that as a buying opportunity. Regardless of how fearful everything becomes, this is a very important factor. 63% of companies are beating on EPS, 39% are beating on sales, and 21% are beating on both. But more importantly, you can see here, energy is getting a downgrade, comm service is getting a downgrade, and as we mentioned in the last video, utilities is getting an upgrade. Now, to see consumer discretionary also getting a positive earnings upgrade shows you that the American consumer must be a little bit better than we expect. And we'll take a look at that on the charts later on to see whether that's still holding through and how you can really look at that to make sure the economy is expanding in a visual format. It's very important to be able to visualize these things. So what is the market going to expect moving forward? Well, it's all been about Mag 7 stocks. In future earnings, it better be about the rest of the market, excluding the Mag 7. If it doesn't come through as a broad market rally, then we're in trouble. But at this point, of course, that's what the market's expecting. And it doesn't really say that the other 493 stocks need to do well. It all comes down to the Mag 7. And with Apple coming still this week, and of course, Nvidia in a month, there's a lot of turmoil that can happen before that event. Now, why is it important to often wait for the close? We mention this all the time. I've always said the close is the key. And over the last 24 hours, the close was definitely a selling key. Everyone was selling right into it, showing that we'd flipped into a negative gamma environment, and most likely there was a bunch of hedging going into the close of the day. Well, it seems like this is becoming even more of a trade moving forward. And I think this is a lot to do with zero DTEs. And you'll notice there's actually an upward trend of close getting the most trades. 33% of all S&P 500 stock trades are now placed in that close last kind of 15-ish minutes. So why is that important? Well, it means that we need to look at those points and make sure that if they're breaking zones or we close on low, that keeps that sentiment. With FOMC coming soon, we also have non-farm payrolls this week. It's expected to cool a little bit, but still remain very strong. And of course, the US economy still has a huge amount of jobs on it. Whether you trust that figure or not, is certainly open for discussion. But at the moment, it looks like it's still going to be good, at least from most tracked records. What is the FOMC going to be talking about? Well, expect Powell to potentially tilt hawkish. A lot of people discussing the idea that there could be another hike in the US. I think they're going to be a bit more cautious on that. They'll probably just hold it. We'll have to see. In general, they would be happy to see growth. They're probably happy to see an upward market in an election year. So I would think that they probably stick to the plan. But I could see Powell saying something about being hawkish. Maybe the markets would freak out. If they do move underneath the 20-weekly moving average, which we'll look at soon, that could lead into that flash sell that goes to a better buy the dip scenario. And will you be wanting to buy the dip? Well, let's have a look at the market health. So firstly, if we go to seasonality, one of the worst stocks that's been performing so far of the Mag 7 has been Apple, not doing so well. May does tend to bring the bulls back into it though. So just remember, we're now entering into May. We're entering into a period where Apple tends to do better. We have to therefore see the price action for that to occur, and we can start to talk about it across the board. The other thing is that we want to see if we've actually got a global market doing better, the emerging markets and some of the other areas start to improve. Recently, we've had Europe doing very well. China looks like it possibly is turning to the upside. And of course, we've got the FTSE, Australian 200, other markets, Canada, they're all breaking up. Emerging markets also holding their own against the domestic market overall network. So I think that's very, very important. When we go to whether we can actually continue to see a rally for the rest of the year or whether we expect volatility to be around here, you can see that Wayne has gone through and he said when you win 3 months in a row, then of course we have a negative month, which we now have for April. We do tend to still have a very bullish catalyst moving forward through the next 6 months, with the next 3 months being the most potential for shakiness, which is where we are right now. And just remember, most risk-on asset ratios, including what we'll look at, which is the bonds market later on, is still not freaking out. And that's a very important factor. If the bonds market was freaking out and the stock market was coming down, I'd be a little bit more terrified. That isn't happening, and we'll show you why very soon. When we have a look at the last 24 hours, gold stocks took the biggest hammering. Of course, gold down 4.72%. Defensives, as we mentioned, up. But overall, still very bullish on gold. This is the pullback that you really do need to see in stocks. And of course, in gold after such a huge rally. Let's move over to the S&P 500. So first on the surface, what do we know? Well, the market closed right on the low, signaling that there certainly was selling into the end of the session. And if we continue in a negative gamma environment, which we'll look at soon, and break through in particular 49.80, then we could be looking at a bit of a heavy sell. Now you'll notice the 50-week moving average has actually moved into our overall defended level. So if we break through here, then where do we go to next? I believe it's around 4,700, and I think that could be a fairly large flash sell. It's not there just yet, so that is important, but let's have a look at the smaller time frames, such as the 5-minute. Always important to understand how the market traded during the session, more than just the futures, and you'll notice here it was actually sell-off during the session in general. We made it through 50.70, which of course was a bear trigger zone. And then we just kept selling throughout the session, hitting into 50.35, which is very close. Remember 50.40 being where the puts mostly sat over the last 24 hours to, that negative gamma situation. We moved into that around 50.70, and then we sold straight into the put wall. So the markets certainly are trading around these 0 DTEs. When we have a look at the futures market action, you can see here it was sell, moves through 50.70, continue to sell all the way down now to 50.18. And I've updated a couple of zones. First up, I think for the bears, they're going to be wanting to look at how the market interacts with the 50.60 and 50.70 zone over the next 24 hours. If we do rally up through the FOMC, this is not only the most traded zone, but it also is where bears gain control of this market on the smaller timeframes. So for basically bears, this is a very important level, and things like fibs as well could be drawn from the top to wherever we end up being. So let's say, for example, right now, if we look at this, a 61.8 sits at around 50.80. What if we drop a little bit more into the FOMC meeting? We go down to maybe this support down here at 49.90, 4,900. Sorry, 5,000. And then if we hit that level, then a 61.8 would sit around the bear control zone. So my favorite scenario would be something like this. And that would be actually pretty good for the bears. And we also know that 49.80 is the next huge negative gamma switch area. So we're already in negative gamma, but if it gets underneath 49.80, which is the put support at this point, so that's where the bulls will sit around this level here. I don't think they sit here. I think they sit more than likely around this level. Then if they lose that level, we're most likely going to a new low, and then that pushes that 50-week moving average being a real possibility. So, people that are looking at deeper pullbacks, it is a real possibility of coming through maybe in less than a couple of sessions if we start to really see an acceleration in selling. Now, this positive gamma switch area was, of course, a very difficult zone. When you start to look at things like the Russell 2000 or, of course, the US 100, which we'll do later on, you'll notice both were at supply zones. We also got just through that 5100, which, of course, was a slight positive gamma level. But if we looked at the ES futures as well, which we discussed in our last video, we found that it was right on the res. So right where all the calls would be plowing to basically force a squeezing environment. We weren't able to hold above that zone. Now, if we did, of course, I think the market was going to around 5200 at that point. But this is how fast things can switch. And of course, when 50.70 was taken, it was always going to be continuous bear action for at least the time being. Let's now look at the 0 DTEs so we can understand a little bit better why everything's changed so much. Puts were stacked in big time. You can see 5,000's got a bit of calls on it. 49.80 getting massively stacked into the FOMC risk event. So of course, the market will try to hold above this, but if it loses ground to this one, negative gamma takes over completely and we start to see lots of hedging. And then you'll notice that on the 2nd of May, we also have the 50-50 zone, which just so happens to be very close to where we think those bears and the most traded level is. So if we keep remaining underneath 50-50 over the next 2 sessions, again, more hedging may need to be done. And we are clearly in the negative gamma side. So because we're in that, it's kind of just like the same as what we saw with positive gamma. We are in a point where if we stay low and we hold it, then the close will need more transactions. And as we can see, 33% of transactions are going through at the end of the day. 4,900 remains a very important point for this month's OPEX now that we're in May, but we're far off that. So I think that anything that goes underneath 4,900, I wouldn't be surprised at all to see it be bought quite heavily up, specifically around that 47 to 4,800 zone, which is where that 50-week moving average is. Let's now take a look at what CTAs are doing. So these will be 1 day delayed. So you can see here CTAs were purchasing. It's pretty normal. They love purchasing the 20-week moving average. Of course, the 20-week moving average being one of the best areas to generally add to, position-based investing, DCA, that type of stuff we've seen in the past. S&P versus, of course, the CTAs. You can see again, they were picking it up. So that makes sense. And let's just include 2 other ones. I've got 2 other stocks that I thought might be worth bringing in. Firstly, the positioning of course, Tesla. I've updated that. So 180 being a huge zone of contention. In the last video, we talked about how we thought that the squeeze would probably come off. We'd go back towards 180 and maybe even fill at around 174 to fill the gaps that sit around that level. It does seem more likely than not that this is still a very real possibility. Want to move almost 40% to the upside, drop it back a little bit, and then possibly see the buyers recommence. I do also think Kramer put the jinx on Tesla, though, over the last 24 hours. He was he was really bullish at that 200 zone, and yeah, it just didn't make sense for it to get to 200 and then hold, because retail traders need to get ruined both ways before it goes long. Yeah, and when it pulls back here, I do think that there could be a nice catalyst towards the upside still in everything that we've heard. Even though there's no real earnings behind it yet, the market does love a good AI story. AMD, on the other side, was not doing well at all. This one actually falling straight back down, getting closer and underneath that 150 put zone. 145, you'll notice on the 10th of May expiration is a huge amount of puts, and then 140 for the overall OPEX point. So basically, AMD will want to hold within that 140 to 150 kind of range. And if it can manage to do that, then that will be relatively strong for the bulls. And you'll notice that a lot of people had stacked calls all over it. So unfortunately, they are more than likely going to lose all of their positions. So I think retail was going pretty strong for AMD, and the market just went, yep, no. Like how most retail were trying to short Tesla, most retail looked like they were probably trying to buy AMD. So are we looking at a market that's actually completely changed and looking super negative? Well, on one aspect, which is this one here, the rest of the year when we have a negative April on the S&P, the returns actually are not very good for the rest of the year. Now, this is only one stat, and I think you'll find that there are a lot of other stats out there. But generally speaking, we end up getting a May that's kind of weak. We get a lot of sideways action. And then, of course, we get down into November, being right around when we have the election. And then, of course, we end up rallying. And we have quite a strong period from that point in time. Now, is this the main case scenario? Well, we know that in election years, a 10% drawdown is very possible. In fact, it's the average when you take out the outliers being negative 48, negative 33, and you end up getting around negative 10 as a possibility. That's where the 50-week moving average is. And if we overlay a lot of the periods, specifically we overlay how this year has turned out so far, we found ourselves literally here over the last 24 hours. Now, in this case, what usually happened was we actually did have a weak May into an incredible end of the year. So this is still a very real possibility. And if you notice, if we overlay all of the markets together in election years, 2012 and 1976 are the most close. Now, the 70s is the most important one because, of course, inflation was there. And in these situations, we led into May. We saw some pickups. We saw sells in both cases throughout May. And again, it's just, a scenario. But I think what's important here is that in both of those scenarios, we got buy the dips. So in the most correlated markets to currently, if we do fall off, are we still looking at a buy the dip situation? I've got, again, some read on the bonds market that might surprise you in just a few moments. So Amazon's out of the way. AMD's out of the way. Amazon gets a tick, very nice on the earnings. I think it's exceptional. AMD, probably more of a question mark, what's going on there. Now everyone moves on to things like Qualcomm. Obviously, we've also got Apple, Coinbase, Cloudflare, one of my stocks that I've always liked in the markets, and plenty of others. This is the second largest earnings week, but all eyes will be, of course, on Apple from now on. And do remember that while Amazon didn't move as much as maybe we expected, plus minus 8 from the market, AMD certainly did. So AMD moved, pretty heavily, maybe not plus minus 9, but it was moving a lot. Keep an eye on this type of thing. The stocks are expected to move in the hundreds of billions during this earnings season, which makes it one of the wildest on records. Now, I always like to bring you guys any dark pool or unusual activity if it does come through. Dark pool activity basically is where banks or institutions are doing deals with each other, and they're not doing it on the generalized network, so you won't be able to see it usually. And you can see here that ProShares ultra short queues did get some nice trades into them. Now, there have been two trades. You could argue that this was maybe the trade close of the other one, or it was possibly a new short added. Remember, this is ultra short queues, so leveraged positions into potentially seeing weakness in the NASDAQ. Again, if we start to see that follow through, that shows that there is a better chance that we get what we call a waterfall moment, where the market breaks to a new low, being the 20 weekly moving average on the S&P, and then that creates kind of like a flash feed on itself event in the negative gamma situation. So the VIX was a little sneaky, went just underneath 15, then it rallied back up to 15.64. I wouldn't say it's freaking out. So clearly the market is not freaking out underneath the hood. And when we look at some of our lead indicators, such as this one here, which is tracking options in the market towards bonds, as an investor, I wouldn't be terrified. This is going down. That is not a sign of the markets freaking out. And that is a very important factor. Also, when we take interest rates out of bonds, and we look at bonds on the surface, especially corps in America, you'll notice here on our bond indicator, it's not freaking out. So in general, things are not really looking like they're freaking out. Now, if you load up something like junk bonds, you can see that they've come back to that point where we broke through the other day and found some resistance, and of course are selling off. But in general, I would say the bonds market is not showing incredible signs of stress, which usually you want to be paying more attention to. So we'll see how that updates after the Fed's FOMC meeting. But yeah, it's not showing signs of stress just yet. Speaking of the Fed, though, and central banks, yeah, they're definitely dropping liquidity across the board here. So markets continue to move down. In fact, the liquidity indicators are moving to points that we haven't seen now since basically September, October of last year. Yet the markets are, of course, a lot higher. So central banks are definitely pulling the pin on how much support they're putting in the markets at this point. If that continues to feed through, I would be looking at, of course, movement down to this market if we get through here. And then what I would expect for it to happen is these central bank indicators to instantly show more liquidity. I bet you they don't want it to fall too much. So if this did happen, I wouldn't be surprised at all to see central bank liquidity inject straight back up, just like it did in the past. Look over here. We fell. Oh, we got to put the injection, get a second drop, keep injecting, and then it was all good. So stabilization factors will matter. We'll keep tracking that and, of course, pay attention. Now, when we're looking at other signs, we also look at Dow Jones Transportations. They just made a new low. Not a good thing for the market, certainly a little bit weak. And on the factors, this is important to look at. We also saw home builders drop, but again, no new low. I think that means that the markets are still relatively healthy. And if we look at XLF, which is, of course, the banking sector, while it dropped, no new low. So overall, I think a lot of the impacts of the market right now are not freaking out. So I wouldn't be freaking out in these markets. Copper did hit pretty much very close to our 4.7 level. I think I had 4.73 on it. So around this zone is where I expect copper to have a breather. It certainly looks like it is going to have a breather. Still very bullish on it over the next 24 months. But at this point, I wouldn't be surprised to see copper continue to drop through. Where or how low could it go? First stop would be about 440 to hit into this 20 daily moving average, which you can see has got a 1 and a 2 on it. So there's likely some kind of buyer that sits around that zone for copper. A pullback in a very strong trend at this point. Dollar index is probably the surprise for a lot of people. It was flagging, or what looked like a flag. This could be a breakout of the flag. I'm always ultra cautious into FOMC and NFP. I like to always have patience and react and not predict. If the market manages to break through 107 though, I do think there could be some seriously strong dollar. That's going to put pressure on gold. It's going to put pressure on copper. It's going to put pressure on the markets. So if we see a wild dollar that starts going super bullish, that's not really great for all of those trades. And I think that it could again push the markets down. When we take a look at gold, it failed to hold. So no doubt, I was remaining on the bullish train up until around this point for gold. It dropped it over the last 24 hours and it's kept going down. I do not like that for gold. I don't think many people do. A lot of people are freaking out about it. You got to put it in perspective, guys. Whenever you jump into a market, you've got to say, well, what's it done? Okay, so has gold fallen off 5.86%? Yeah, sure. But when you think about how much it's up since February, not many months ago, it was up 22 and it's still up a lot. Now, I have a suspicion that gold could flash sell, and it may actually flash sell all the way down to this structure here. You can see I've got 2172 marked, 2200 marked. You could also pull a fib across the whole board if you wanted to and have a look, but there's not much holding it up here on the left-hand side. So I don't have a very strong read on gold from a bull level here. I'm still very bullish on it over the medium long term, 6, 24 months, that kind of thing. Do I still think it's going to hit 3,000? Yes. Do I think it should come down? Based on that closing on the low, it doesn't look very strong. But what do you think in the comments down below? US oil, another one that I thought might find some buyers. I did say in our Market Masters Club, as a free 7-day trial if you're interested, that you probably want to go above here to get in the conservative entry towards the bull side. It was kind of flaky. I definitely thought that this level should maybe be held. But if we lose this level here, which is of course what I've marked as a good bull zone, then I think we go to the great bull zone. I do prefer the Great Bull Zone, as I've mentioned several times. So oil not performing as well as some people would expect. Definitely not a good close after all these wicks, but this is the level that I think enough times out of 10, you usually would find buyers through here. In this case, if we do get underneath though, there's nothing I like until about 78 a barrel. So yeah, oil still looking a bit shaky on the charts. Now let's move over to Tesla. So Tesla hit into that resistance just underneath 200. It's now pulling back, exactly what you would expect at this point. It put on 40% over a few sessions, squeezed the absolute rubbish out of the options market, hit into the supply, selling off. I'd like to see it get back down to the previously most traded zone at around 173, and then maybe fill the gap around here and then look towards buys. You've got different VWAPs, you've got different moving averages and all sorts of ribbons that sit around here. So yeah, I think there's still maybe a little bit more downside on Tesla as we move towards that very nice level. But do I think Tesla has made a big switch? Frankly, I do. Whether you believe it or not, I think it's a huge switch thing that's going on in these markets. So certainly very, very important to look at. AAPL failed to hold. Earnings will ultimately be expensive. Oh, very important here, maybe be expensive as well for some people. We did see almost a gap fill. Nothing much to report on AAPL. Did we break up? No. Did we break down? No. Some people may draw that to a 61.8 fib, look for this level here at 168 and try to go long. It's a gamble at best, I think, at these points. So AAPL, we'll have to wait for the earnings. When we take a look at AMD, post-market crash. Now, this was a 147 move. So the market certainly moved down. As we said in the last 24 hours, we expected res across semis. So I'm just going to show you guys what I meant by that. So here's the 20 moving average. Now, we know that this stock has mostly loved the 20 moving average with one outlier here, but even on the way down, it's found resistance. So this was clearly resistance. Why? Because we can see its supply, previous support becomes resistance as well. Many different technical techniques at this point. So coming into the earnings, certainly at a high point, at a critical point, I wouldn't have necessarily just said, oh, wow, what a great sell. Maybe I would have if I knew so many retail traders were buying calls. But yeah, the earnings came out. It obviously disappointed the market and came down to 147. Looks like on the surface of it, I haven't looked at AMD's earnings because I'm more interested in Amazon, but it looks like it was green. So maybe it was a beat, but the market didn't like it for whatever reason. SMCI is another one, of course, post-market getting hit as well. But notice where we were. As we reported, very similar situation. Support becomes resistance, many other reasons, ends up as a shooting star by the close of the day. And then if you were lucky enough to see that shooting star and you went, you know what, maybe it's worth a YOLO option to the downside, you'd probably be pretty smiley faced at this point. Let's look over on NVIDIA. Was it the same thing? Yeah, we hit the most traded zone. I mean, you want to talk about pinpoint accuracy, that absolutely smashed it. So well done, guys. Like what a level, just bang, straight into it. And of course, after hours coming down. Now, if you're a bull down here, should you be terrified? I don't think so. But this is all in line with what we expect. NVIDIA taking a dive or taking a bit of a breather. Semiconductors in general, if you look at semiconductors versus the SPY, you pop that on a chart, you're going to notice the same phenomenon. We're going back into a supply, we find all these levels, we come out with earnings, some excuses played, and then we come down. So yeah, I don't think it's any surprise to people that have been looking at the charts, to people that have been watching these videos, that this is possible. And now the question becomes, do we take the 20 weekly moving average on the S&P? Because if we do, then 50 becomes possible, the 50 week. And that's a very nice correction zone. I'd be very happy for the market to get there. I think it'd be a good time to look at the markets in a different way. Some people will be very upset with it as well, but it is the type of correction that is better if you are actually in a bull market. Okay, if you're in a bear market, then it will keep starting to fall underneath that, and things will start getting sour. But bonds are not telling us, and a lot of the other leads are not saying that just yet. Aussie 200, what's it doing? Floating around. We expect the UK and the Aussie 200 to hold up better because of their metals, their energy, and their financials across the board. And the Chinese market gave up a little bit of its gains, which is expected. 18K basically hit on the HSI, a little bit of a pullback, ideally into a long. And I've just got Baidu here on the right-hand side, just to show you that there's a lot of stocks ready to break out in the future. So certainly worthwhile setting alerts above these zones for Baidu to see whether they can hold up. When we move over to the US 2K, you'll notice again the supply area. We talked about this possibly trying to break out last 24 hours. I still like this area here for where the bulls kind of sit. So the US 2K, while it looked weak, didn't really go super weak, didn't really get smashed. So this is where I think the generalized buyers sit for the Russell. If the S&P fails, of course, it'll get much worse, but the Russell doesn't look too bad. And the NASDAQ is kind of similar. The NASDAQ's come down to its little defended area, similar to the S&P. They're all hitting at these minor demand zones, and that's all into the FOMC event. So the FOMC event will probably control a lot of what goes on this market. Then we've got Apple as a result. But if Jerome Powell comes out and freaks the market out and they start selling off, then we get much lower levels and a much better potential zone. Now, I've got a little coefficient here, which I just thought I'd bring in, which is, of course, at the moment, how is Bitcoin and the NASDAQ trading together? They're pretty well correlated at 0.76. So because they're at 0.76, what happens if Bitcoin goes early and it starts to sell off? Is that a warning sign? Well, I certainly can't say you want to like this chart right now. It's making a series of course, lower lows. It failed to take control here. It failed that little bit of an area that we talked about in the previous session almost instantly. It's come down here. It hasn't shown that wick that you would like to see. I don't know. I think that it's better towards ideally seeing this price. And we've talked about negative 30% not being unusual in bull markets. This is what Bitcoin likes to do. Big shakeout. I'm super interested to see whether there's any liquidity here. I feel like there's not much. So, the next 24 to 48 hours, wow, it could get wild. If you want to really be a bull in Bitcoin, of course, if you're position-based trading, it doesn't really matter. You could potentially buy some in here. But if it rallies through this bulls take control zone, especially after how it's done this, I think a new all-time high would be very possible because it looks dire when you look at it on a chart. But what do you think? Is Bitcoin going to 52-ish, or is it mooning all the way back up to 70? The current evidence doesn't look that strong on the charts. You've got to be looking at that and saying it, but we'll have to find out. So what's the most important? Well, as we know, we have a whole bunch of annoying information coming out. We've got funds rate, expect that to stay at 5.5. We've got the statement itself, expect the statement to be like, we're confused and we're going to use all the tools and all the normal crap. We don't know what's going on. We're data-driven, that kind of stuff. And then the FOMC press conference, maybe expect Powell to come out and be as wishy-washy as ever, maybe even mentioning a little bit of hawkish stance. The market probably won't like that if he does. Then we've got non-farm payrolls coming out Friday, 8:30 a.m. So will that be strong? It's poised to be pretty good still. So the US economy is still in a relatively healthy situation. If you enjoyed today's show, then remember subscribe and smash that bell icon, and also follow us on the other socials. Thanks so much for watching, guys. I hope you have a great day and good luck out there. Things just got really interesting. And of course, we're moving into a very pivotal time for the markets. Will the bulls prevail or the bears? We've got plenty of good levels to be looking at. And remember, utilities is also a very interesting sector, which we'll put a focus on very soon. Bye for now.